Hi everyone, welcome back to the channel. I got Sashwath with me, and as I was talking in Instagram in our group that I'm going to be discussing the specific topic with Sashwath, which I'd shared with you over there regarding the FIIs and DIs and what they're doing. So if you look at the data which we had presented to you guys in the channel, and which I'm sure Rupesh has put up now on the screen, what you can see is the FIIs and the DIs activities month on month, what it's been doing. First, let's look at the month of October. The month of October, you see from the 1st till 10th, they have been increasingly selling. On the 3rd of October is when they really dropped 15,000 crores worth of sales, while the DIAs have been absorbing all the sales which has been going on. But if you see month-wise, if you see the analysis, since the beginning of the year, January was a big year. Usually it is. The FIs will usually sell in January quite a bit. Feb, they were selling net sellers. And March, they were net buyers. That doesn't mean they didn't sell. It just means if you take the complete month average of all their buying and selling, they were positive. April, they did quite a bit of selling. Then in May was 42, and we thought that was a big month. Then June, July was a little soft, net buyers again. Then August, again, they dropped 21,000 crores. Then in September, 15,000 crores, they pulled back into the Indian market. And so far in October, it's been a massive month of selling for them. They've been selling so far 50. This will give you a clear idea on what the FIIs are doing here in India and the impact it's going to be having for us. At least this month, the trend seems very clear. They seem to be making an exit. This is a follow-on video on what I've been talking to Sashwath about, what's happening, the FIIs, the way they decide to buy and sell, and also clear indication that they're looking at the Chinese stock market, which they consider is completely undervalued to the Indian stock market. So without wasting much time, I'll let Sashwath take this apart a little further and help us understand these numbers a little more.
Sure. Well, it's at this stage, it's difficult to exactly say what is causing the FIIs to pull out. I mean, one thing we do know for certain is, yes, the interest rate in the US is at all-time highs, like all-time highs in the sense in the past 30 years. It hasn't been this high for a few decades. The last time it was this high was well before, I was born. So the important thing here is to note that when interest rates are higher, that means money flies from risky places and it goes back to supposedly risk-free places. So for FIIs, this means pulling money out of the emerging market and taking it back home. Yes, some of you in the comments and some of you who are astute might observe that, look, Sashwath, you're saying this, but then interest rates are coming down in the US. Why are the FIIs continuing to pull? Well, the answer is sort of simple. It's because things take time to act, and just a 0.5 percent cut is not going to undo so many sequences of 0.25 and 0.5 increases. So if you look at the interest rate, it's still quite higher than what it was before. And also, inflation data in the US had come out recently, and the inflation data basically had said that inflation is more resilient than what people were expecting in the US. If you look at core inflation in the US, I think it stood at 3.3%, which is still higher than the 2% mark which the Fed is aiming for. And if you take energy and food along with that, it still comes down to only 2.7. So they still haven't met the 2% mark. That being said, this is not to endorse, no more further rate cuts or something like that. I'm not saying that there shouldn't be rate cuts. What I'm trying to bring to your attention is that the problem of, inflation is not something which we can take a magic wand and wave it away. It's something which, it takes a lot more time and effort. And one thing we need to know about inflation rate is that a lot of products can still go up in price regardless of whether interest rates are high or low. That they have other supply demand factors which push them up, which are unrelated to or directly unrelated to interest rates. So that's one point. And the second point which we of course discussed was take China for example. China has announced its willingness to support its consumption, and they're looking at fiscal stimulus. This has been, I'd say, the situation of China is similar to this. If you've lost all hope in a country and you think that this country is doing the opposite of anything standard in the investment community, let's say when it's going through a recession, they're further prolonging the recession by saying that I'm going to impose these strict terms upon you, I'm going to keep interest rates where they are and all those things, then you lose hope and your valuations come to an all-time low. So China's valuations, the Chinese stock market's valuations, had come to very, very low figures. But any kernel of positive news is enough to revive someone who's on the deathbed. So it's almost like taking a defibrillator machine and giving a nice jolt to investors who had invested in China, because most of them had lost all hope, and suddenly this felt like a nice shock to the chest, which got the heart pumping again. So I'm sure that if this were the case, if China had been following typical fiscal and monetary policies, then we might not have seen such a big effect. People would have just said, okay, this is anything, this is like lackluster. But because China had been following what they had been following for quite a while now, suddenly them saying anything related to this is like a huge shock. So that's the reason why we're probably seeing a lot of money flowing there. So these are basically two important factors we have to keep in mind. I'm not going to say this is a reflection of what people believe in India, because domestic investors are still buying stocks. Whatever the FII has pulled out, the DII has, bought from the FII, and they're keeping it. So I'm surprised at the amount of liquidity that domestic investors are able to give the market, because this is quite surprising that the FIIs have been able to pull out consistently over a few months, and we have been buying it up. So what do you think about this?
I agree with your analysis of what you're saying, and I think you're spot on this. Like when you raise interest rates, the market reacts slowly to it. Same way when you drop interest rates, the market reacts slowly to it. And another important factor is, I would say, US dollar and the Indian rupee, that is. From the beginning of the year, Indian rupee from 83 has gone to 84. And that is also a huge play on this. I wanted you to explain a little bit more, just even 1 rupee movement, why it's such a huge thing for a FII when you take conversion and profitability of a stock. Why even 1 rupee can look like a huge amount. Though for a layman, you're like, why are you saying 1 rupee is not a big deal?
So, yeah, that's a good point you're bringing up. So, 1 rupee is not just 1 rupee, right? Because investors, you and me as investors, you and me as I'm talking about the audience, I'm now referring to you. I'm sure all of you guys are avoiding leverage and avoiding derivatives like good investors. And I'm sure you've been watching our videos, and I know that all of you are aware of all the risks that are involved with taking on debt. But there are other investors whose investment philosophy strays away from the money pay to be rich, angle of investing, and mainly the Warren Buffett way of investing. There are a lot of people out there who stray away from that. And institutional investors, in the especially abroad with hedge funds, you see that most of them are happy to take on a bit of leverage to maximize their returns. So what you end up seeing is that even a 1% drop with the rupee declining in value against the dollar could mean sometimes a 20% drop in your portfolio, a 20% loss, because you have now taken on enough leverage to really magnify any positive gain or loss you get from the asset. So for example, so let's say you have 10 rupees and you take on 20 times 10 rupees, so that's like $200, right? Yeah, so you take 200 rupees and borrow it, and then you put in your 10 rupees, and then you start buying up stocks in India, and let's say you live abroad. Then even a 1 rupee decline is going to hit you massively, because that 200 rupees doesn't belong to you, it belongs to someone else. You have to give that money back, and if they see your portfolio value come down, then they're immediately going to do margin calls. And if margin calls are inbound, then that basically means that, look, time's up, the game is finished, and you have become bankrupt. That's the worst case scenario. I'm sure a lot of these funds have hedged their portfolios against currency risk, and there's a lot more nuance involved. But the important point here to take is that what might be a tiny, flicker in the grand scheme of things for us as investors is not a tiny flicker. We have been proponents of avoiding debt and avoiding leverage because of this exactly. Because if you had taken on debt, which I'm sure you haven't, but if you have, then you would notice that even a small 1%, 2% loss here and there or gain here and there could basically mean you clutching your heart. This is also a learning lesson for us, because this tells us why we should be avoiding debt. So this is interesting, because one of the first lessons my other uncle had taught me was that if you borrow, even a 1 rupee gain or a loss on your asset could mean you're wiped out. And in my mind, when I was a kid, I couldn't, process that. I was like, what do you mean? But he gave me this exact example, and he said that, look, you make a 1 rupee gain, you're a millionaire. If you lose 1 rupee, you're finished. And more often than not, you do end up losing 1 rupee, and you're going to be finished, and you're going to be on the streets. So this is something he taught me well before he was on YouTube and MoneyPechu and all those things. And today, all of you have the privilege of listening to that and taking in that information. So a lot of you have said that, I'm very lucky, and I am very lucky to have him as my uncle. But all of you are very lucky because you get to hear him through, MoneyPechu and Be Rich every day. So yeah, please do keep watching because these videos are meant for all of you at home.
Another question which I wanted to ask you was, the government of India recently came out saying that they're going to be launching an Indian sovereign wealth fund. Like a lot of countries around the world, including even China, even Pakistan has a sovereign wealth fund. And they're planning to transfer the public sector stocks initially to help fuel funding for this sovereign wealth fund. And around 50 lakh crore or some huge amount of money has been issued for towards this. And they plan to slowly put more money into this. And one of the main idea behind this is to invest abroad, like other sovereign wealth fund. The other is to use it to stabilize the Indian economy when requirement is there in the stock market or wherever to step in and offer stability. How much of this do you think would make an impact going forward? Has the extreme volatility which we have seen in Indian stock markets because of the FIIs moving in and out, and now the DII support, plus the sovereign wealth fund also may be coming in sometime soon. Do you think the days of seeing massive swings are really over? That if we do see correction, it will be in a stepward manner, and same way growth will also be in a step manner, then seeing huge movements in the index overall. Maybe individual stocks can move, but index overall, do you think like the S&P which we see now, where we don't see huge movements in the S&P? Yes, over a period of time, it can be downward. Over a period of time, it can show upwards. And the percentages have become very small in terms of a 5% growth in your S&P is considered very good. So I wanted to get your opinion about this too.
I don't mean to be derisive, but I find it hilarious that we don't even have a trade surplus and we're looking to invest. Because let's take this from an individual perspective. I mean, this is a big government we're talking about, but I want those at home to follow me on this exercise. We have always said that if you do not have the money to invest, that is, if you are in debt, then you should be focused on paying off the debt before you start investing in the market. And more so, if you are taking on debt because you're not even making enough money, then we've always said, please don't borrow to invest. Please don't borrow to invest, and please pay off your debts. The state here in question is India, of course. And I love my country, but then it makes very little sense when you're not making a positive amount on a trade surplus, because this is what you're producing in the country which you're giving out to the world. So your trade surplus is in a deficit. You're exporting more than you're importing. That already means that you have to sell your assets in order to pay for the amount of consumption you're doing. So you're subsidizing your consumption through selling your financial assets. And now you're saying that on top of this, I'm going to go and invest in financial assets elsewhere, or even in India, for example. Let's just say you're investing internally. Where are we getting this money from? I mean, okay, you're going to raise the money by selling more of your stake in public sector companies, and reducing your stake in public sector companies. I think it's a good thing that they're reducing their stake in public sector companies, but I don't know why we need a sovereign wealth fund for it, because that's going to be a one-off thing. The most consistent and stable way for you to run a sovereign wealth fund is for you to have a trade surplus. This is something which we see. So let's look at the countries which do have sovereign wealth funds. So take a country like, I don't know, Saudi Arabia, for example. Saudi Arabia has a very famous sovereign wealth fund. I mean, why does it make sense for them? Because they export oil. It's something which, they get a lot of money for. They need to put this money somewhere. They can either take this money and invest it abroad through their sovereign wealth fund, or they can take this money and invest it internally. That can also be done through the sovereign wealth fund. I'm pretty sure China has a sovereign wealth fund. I mean, why does China have a sovereign wealth fund? Look at their
even Singapore. Yeah, even Singapore.
Singapore. Take another example. So wait, does Singapore have a trade surplus? Yeah, Singapore recorded a trade surplus. So what I'm trying to say here is that you need the money to come in from somewhere, and it can't be just selling more assets to buy more assets. That doesn't make much sense to me. Either you're going to be borrowing to buy consumption, and then you're borrowing now you're going to sell whatever you have, whatever is remaining, to buy other assets. So this feels more like market manipulation to me than it does like, investing per se, because you're just taking money from one avenue of what you have and then putting it into another avenue. And maybe their idea is that they take their excess forex reserves and they might want to park it in a sovereign wealth fund or something. Why call it a sovereign wealth fund then? That doesn't, I mean, okay, go for it, I guess. But yeah.
Anyway, that was very astute and well thought out what you just said. I completely agree with you. So we'll have to wait and watch. A lot of viewers did say this, ask me, so I wanted to ask it to you and also get your opinion on it. So there are forces at play in our market. You can see it. So this doesn't mean we are headed for a correction or that we are in the middle of a huge correction. We are nowhere near that. Our markets have only moved around 3 to 4%. Though FIIs have been selling rapidly, our DIs have been buying rapidly. So the movement in the market as a retail investor, if you see, is not much. So do stay in your tiffin coffee ranges. Don't get overexcited. Don't think you're going to miss out in some stock. If you see even like Manappuram correcting 17%, 20%, it does not mean it is a huge correction which we should immediately come with all our money into it. Still continue buying at different coffee ranges. Anand has been saying this in all the platforms to rein in your excitement. If you have been following us for some time, if you're a value investor, control, your excitement. Don't get zealous and throw in the whole war chest, whatever you've been carefully curating till now, and go after something just because you think it is the right time. It is not. If anything, all this is telling you is we are in more volatility is expected in the coming months ahead, with Israel and Iran still boiling over, and we have no clear indication what Israel plans to do. They are planning. It is going to come. What is going to come, we do not know. So factoring all that in, plus the Indian rupee, the way it is positioned, plus China, I would say you should be cautious and keep investing when you see value at small pockets and not huge bets. What do you think, Shashwath?
I agree, and I think that you can't go wrong with dollar cost averaging or SIPing. A fixed amount every month, and unless there's a huge correction, then of course you can try to pinch some pennies and try to put more money into the stock market. But otherwise, I think taking a slow and methodical approach to it is always a good idea, and you can never go wrong with it. So yeah.
Great. I hope you guys got a clarity on this. And do watch, like Shashwath said, Anand's other channels, because he is there and he offers far more insight than me and Shashwath are offering. So it will be great if you follow him there. He's got a Hindi channel also called Paisa Boltha Hai, where he talks in Hindi. So those of you who consume Hindi media and know Hindi, you can definitely follow him there too. And you can get some more information from him over there. So thanks for watching the video. We wish you a wonderful week ahead as you get into another Monday. And me and Shashwath will be back another day with another video. So thanks for watching Be Rich today.
Thank you. Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends, and a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.